Hi folks, this is Doc Severson. After watching a couple of my videos, hopefully you're starting to get a feel for what it is that I'm doing with not only the charts, but also how I'm employing them with weekly options. I wanted to give you a really quick example of a trade that I just closed out yesterday. Now, the way that the chart looks right now is when we entered this trade, which was on March 7th. So this is just a couple of weeks ago that we entered this trade, and the justification that I felt for this trade is I look at the S&P 500 with the monthly, the weekly, the daily, and over on the right here you can just see a sliver of the 78-minute chart. We're not going to feature that one in today's video. So this is mostly going to be keyed off of the daily chart, and what I saw was what you should be familiar now with, the exhaustion signal down here. So I felt that after this strong linear move up here, which was in a confluence with overhead resistance, which I felt was going to be right around at the SPY 200 level, as well as we have this pesky old 200-day moving average. Now, I don't use moving averages very often in terms of actual levels to sell against, but I felt that this was what we call a confluence, when you get multiple metrics and factors stacking up on each other to create more overhead supply than we normally would have. Now, one of the reasons why I want to share this example with you is not to say, hey, here's another winning trade. You know, anybody can do that. What I want to show you here is the thinking and the analysis behind the entry of this trade and why we felt that this was a good probability trade to enter. However, things went against me, but I was still able to profit from that, which I think is very important, that we show how we can set up a trade where you can be still wrong and still find a way to profit from it. Okay, so again, really the thinking behind this trade is that we had a time frame that I was showing exhaustion here. Maybe I was about a day late on this because it was certainly down here. Down on the 30 level, usually trends do not continue once they hit 30 like this. They usually are going to walk sideways for a number of days or maybe even pull back within this area. So there was a couple of things that I could have done with this. One of them was to set up a calendar spread. That was one option that I could have set up for this trade. However, what we've been seeing is that the price is just moving around a bit too much to set up an at-the-money calendar spread. So it would have required me to do some unnecessary adjustments. Actually, I'd already gone through one of these before down here, which was a difficult trade to manage. And so this is typically a trade that we're going to use for quiet and trending markets, quiet and trending bull markets, which we're typically going to see through periods like this, not when the market's flailing around like this. What I could have also done was to set up a bear call spread. So in other words, I could have set up a purely bearish to neutral directional trade that as long as it stayed underneath this level or stayed at the money or lower than this, then I could have made a nice profit for this. What I chose to do instead was to set up an iron condor. So an iron condor basically is a dual-headed credit spread where we say as long as the price stays below this level and as long as it stays above this level in the time period of the trade, in this case the levels were 195 to the downside and 204 to the upside. So we almost had 100 points to work with over the course of about 3 weeks or so for the duration of this trade. So I felt that this was a good bet. The price would probably stay sideways, perhaps go down a little bit, test out the bottom end of this and maybe bounce back up again. By that time, I should be in and out of this trade, reducing my hold time. Well, let's see what happened over the next couple of weeks. Now, here is a trade at setup. If you're familiar with the trade analyzer that comes with some brokers, here is the section of the trade that represents loss to the downside. So it's below the zero line. Here is also loss to the upside. So we wanted to stay within this range. This is where the profitable area is of the trade, which was essentially between 195 and 204. So we had about 90 points on the full S&Ps, or about 9 points on the spiders for the profitable area of this trade. Notice also that I'm looking at a 1-to-1 reward to risk area. So for everything that I'm looking to reward myself with, here's the potential risk, and it is the same on here. So we're looking for conditions where we can catch this thing. Now, I don't look for the entire profit of this trade. Don't look for the profit of this trade. What we look for is a high probability chance where we can get in and get, say, about 20% of return on this trade. And then again, if we step into a situation where it's obviously not working out, we tend to limit our risk in those and not look for the full loss. So this was the starting point for the trade. This is essentially what the analyzer looked at. So I could have gone down, the price could have gone back up and then back down again. So we had a full range for this to work with. So again, let's see how this actually worked out. I'm going to show you now the price chart of how it looked yesterday when I closed this trade out. Okay, back to the chart. So we entered on March 7th and we exited this trade on March 24th. So here was the entry point here. Here was that day right there, okay, as the price was right at that 200 level on the spiders. And you can see that we did actually have a little reaction down here. And what we saw the S&P do was precisely what it needed to do to be able to gain energy again. It consolidated, it went sideways at that level for about 1, 2, 3, 4, 5 days or so, and it built up just enough energy for it to break out and keep moving higher. And this is typically what we will see with this type of market is when you come up with a level that you think will arrest the price or offer resistance, it's going to do everything in its power to disappoint the greatest number of traders out there. So again, what you have to do is you start with a theory for a trade. You start with a hypothesis for the trade of what you think will do, and you put as many odds in your favor as you possibly can. But even that isn't good enough sometimes. And then we fall back on the probabilities of the trade. Now remember that our upside level on this trade was 204. The downside level was 195. So the downside credit spread was never ever threatened on this trade. And the upside credit spread certainly was. But we didn't panic. We didn't say, oh, as soon as it touches the upper boundary, we're going to get out of this trade. No. We felt that at some point, markets can't continue to go higher infinitely. So at some point, we're going to get a reversion back to the mean. We still had plenty of time. And that's what happened yesterday as the price pulled back. And that's all it took, because what you also have to figure is that we had all of this time decay happening here. So all of this time decay occurred with the options that we sold, and that was enough for us to secure a 12% return on risk for the trade, which is not stupendous, and a lot of that was due to the commissions. Let me show you that. So here are the results for the trade. You can see that we got into this trade with a 50-cent credit. Okay, so a 50-cent credit with a $1 wide spread in each side means that we were looking to gain 50 cents and we were risking 50 cents. Okay, and the exit actually came in a couple of stages. This is why we have a couple of different orders. When you have a good till cancel order, it'll keep filling until you complete the order, and this is what happens. So these were a few minutes apart, and it finally closed down for a debit in this case. So when you enter for a credit, you want to close it down for a debit. Now, a lot of these trades I do with the spiders because it's very granular. You can get very tight spreads on here. It's very easy to trade, and it's good for customers that have smaller accounts so that they can not only participate in the trade, but they can also get the same fills as everybody else. If I had been trading this with my own account looking for returns on this one, I certainly would have used the SPX or the SPX PM for much more efficiency. I mean, if you think about this, with 5 contracts, we actually had at $1 a contract, I had $80 in commissions as part of this trade, which is not very efficient whatsoever. And this is why we had such a low number here. But again, if you continue making 10 to 12% or even as much as 20% on trades again and again and again, when you put the odds in your favor, these do add up. Not only from a monetary perspective, but also you get a sense of confidence. Now, don't forget, when we set up this trade, we had identified our maximum risk that we were going to take on this trade from day one. So there was no loss of sleep at night. There was no staring at the ceiling, wondering what's going to happen tomorrow, what's going to happen with Asia, what's going to happen with Europe, what's going to happen in the political sense, what the Fed is going to do, anything like that. We had capped our risk from day one on this trade. So again, the point I just want to leave you with here is that here's another example where the chart ended up doing something that we didn't expect it to do, but we didn't fight against it. We just merely put ourselves in a position to win, didn't get greedy. The whole point here is to get in, take your fair share, get out, manage your risk, put the odds in your favor. I hope this helps. Let me know if you have any questions on this. Thank you.